I need to tell you about something happening right now that almost nobody is reading correctly. In the last 30 days, $11 billion left gold ETFs in a single wave. Turkey liquidated 60 tons of bullion in 2 weeks, and gold fell 21% from its January peak. Every financial channel is asking, why is gold falling during a war? I want to ask a different question. What does this create? Because in 40 years of studying markets, I have learned that the biggest wealth events don't look like opportunities when they happen. They look like disasters. I have seen this pattern before. In 2008, I watched gold fall while banks collapsed. In 2020, I watched it drop while the pandemic shut down the world. Both times, the investors who understood the mechanism made fortunes. Right now, 3 completely separate wealth windows are opening at the same time. I have not seen this alignment since 1979. Here is what I want to explain. First, why gold's collapse is actually the most bullish signal I have seen in years. Second, a sector where institutional money is moving in a way that mirrors one of the most reliable patterns of the last 50 years. And third, the most structurally predictable wealth transfer in pharmaceutical history and why the clock is already running. These are not opinions, these are sequences. Let me tell you what is actually happening in gold. When markets face a simultaneous oil shock and hawkish Fed response, something specific occurs. Leveraged funds get caught. When oil spikes past $110 and the Fed cannot cut rates, those funds face margin calls. And when you face a margin call, you sell your best performing asset first. Gold had risen 65% in the 12 months prior. It was the most profitable position on institutional books, so they sold it, not because they stopped believing, because they had to. In 2008, 2020, and 2022, gold initially fell as investors sold assets to raise cash. In all 3 cases, gold recovered and made new highs once forced selling exhausted. 11 billion left gold ETFs in March. That is institutions meeting margin calls. The structural reason to own gold, de-dollarization, fiscal deficits, central bank diversification, has not changed. What changed is who was selling. JP Morgan maintained its year-end target at $6,300. Deutsche Bank is at $6,000. Neither bank moved those targets despite the sell-off. That gap between $4,300 today and $6,300 is not a prediction. It is a thesis about what happens when forced selling stops. And I have been studying debt cycles for 4 decades. When I look at what is happening now, I see a pattern that shows up without fail at major inflection points. Moments of maximum confusion create the widest gap between price and value. Right now, that gap exists in 3 separate places. Let me be precise about what forced selling means, because most people use the phrase without understanding the mechanics. Turkey is a case study. The Turkish lira hit its 11th consecutive record low against the dollar in the 16 trading days following the outbreak of the Iran conflict. The Central Bank of Turkey holds over 500 tons of gold at the Bank of England. They liquidated approximately 60 tons in the market. India became a net seller. Gulf sovereign wealth funds showed up in the London bullion market data as a 45-ton outflow above the normal average. Here is what I want you to write down. These entities did not stop believing in gold. They needed dollars, emergency dollars, to pay for oil that now costs 40% more than it did 60 days ago. They are selling family silver to pay a temporary bill. And here's the mechanism that follows consistently in every cycle I have studied. When the emergency is over, when oil settles, when currency pressure eases, those same entities come back. They do not come back gently. They come back urgently because their reserve diversification mandate requires it. The World Gold Council forecasts central banks will buy approximately 850 tons in what some analysts project for the year ahead, almost identical to last year's pace. The buyers did not leave. The sellers were temporary. Now let me tell you about silver because it tells a different story and in some ways a more interesting one. Silver has 2 demand sources that gold does not have: investment demand and industrial demand. Silver is now in its 5th consecutive year of industrial supply deficit. Solar panels, electric vehicles, AI data centers. Each is an inelastic buyer of silver. They do not care about price. They need the metal to build the machines the global economy requires. The gap between paper silver, futures contracts, and ETF shares and physical silver has been one of the defining structural distortions of the past decade. At some point, the gap closes. It always does. When it does, it closes fast. Now the second window, coal. For a decade, institutional capital avoided it. ESG restrictions, environmental mandates. Coal mining companies were starved of investment. That is why it is interesting now. When Brent crude trades above $100, it changes the economics of every alternative energy source. Utilities make arithmetic decisions, not ideological ones. When gas prices spike because LNG supply chains are disrupted, utilities look for the cheapest alternative. That is coal. In Europe, coal-fired plants are cheaper to run than gas-fired plants right now. European utilities are rebuilding coal inventory for what may be a longer burning season than forecasts suggested 3 months ago. In India, coal supplies nearly 79% of domestic energy. Production reached over 1 billion tons in the recent fiscal year. India's oil import dependence runs at nearly 89%, which means every oil price shock is an emergency for energy planners. Their response consistently is to maximize domestic coal output. A decade of ESG divestment suppressed capital expenditure globally. Supply shrank. Now demand is rising because energy prices changed. Constrained supply meeting rising demand produces the most powerful commodity moves. Coking coal has a separate driver, defense spending. Every major defense surge requires steel, ships, tanks, systems. You cannot make steel without coking coal. Industry forecasts project $215 to $222 per ton ahead. Coal India is up over 11% year to date, while the broader market is down. That is money rotating into a sector most investors were told to avoid. The third window is the most structurally predictable. The events are scheduled. The dates are known. The pharmaceutical industry faces loss of patent protection on approximately $300 billion in annual revenue approaching 2030. This is not speculation. Major blockbuster drugs generating tens of billions have patents scheduled to expire. When biologics lose patent protection, revenue can drop 80%. These companies know this. Their boards know this. Their investment bankers know this. Their response is acquire. Pharma cannot build new blockbusters in 2 years. Internal development takes 10 to 15 years on average and costs approximately $2.2 billion per asset. They do not have time, so they buy what exists. Industry estimates place combined M&A firepower at $1.2 trillion. Deal value in the most recent year showed substantial increases. Consulting firms project over 20 acquisitions above $1 billion ahead. The mechanism is simple. Big pharma searches for small biotech with promising candidates. When they acquire, they pay significant premiums. Sometimes 30%, sometimes 50%, sometimes 100% above trading price. If you are invested before acquisition, you capture that premium. The question is not whether this happens. The deals are being announced. The question is whether you understand the pattern. I want to be clear about risk. Biotech carries high failure rates. Clinical trials fail. Individual companies can go to zero. This is not a sector for concentrated bets. The appropriate exposure is diversified, broad-based biotech ETFs, or larger pharmaceutical companies already navigating the patent cliff through acquisitions. Let me bring these 3 windows together. The gold sell-off is forced liquidation, not fundamental change. Structural buyers are still present. Price separated from value. That separation will close. The energy shift toward coal is supply starvation meeting demand recovery. It is a cycle within a trend. The biotech patent cliff is mechanical. Demand is quantified. Supply is identified. Timeline is published. What unites all 3 is price versus value. Price is what the market assigns now under these conditions. Forced sellers, panic, margin calls. Value is what a thing is worth when conditions normalize. The gap is where wealth is created. In 1979, gold fell sharply as the Fed raised rates to fight oil-driven inflation. The Iranian Revolution drove oil above $40 per barrel. The Federal Reserve under Volcker raised rates aggressively. Most investors sold their gold. They looked at falling prices and concluded the thesis was broken. Those who held or bought saw gold rise more than 200% in the following 3 years, from roughly $250 per ounce to over $800. I am not predicting identical outcomes. I am identifying identical mechanisms. Oil shock creates inflation. Inflation forces Fed hawkishness. Hawkishness creates forced selling. Forced selling creates the gap between price and value, then the gap closes. In every cycle I have studied, there are two types of investors at inflection points. The first type sees price falling and concludes the thesis changed. They sell or stay out. They wait for certainty. By the time certainty arrives, price already moved. The second type asks, why is price falling? They determine whether the answer reflects changed value or changed sellers. Right now, the answer is forced selling, emergency liquidity, countries paying oil bills with gold they would rather keep. The value has not changed. The investor who understands that difference has an advantage that does not last long. Markets are efficient in the long run. They are inefficient in the short run, precisely in these moments of maximum confusion. This is one of those moments. 3 windows, each with different mechanics, each with different timelines, but all opening simultaneously. Gold and silver, where the gap between price and value is the widest it has been in this cycle, created by forced liquidation that has nothing to do with structural reasons to own them. Coal, where a decade of supply starvation is meeting demand recovery driven by the most significant energy shock in a generation. Biotech, where $1.2 trillion in pharmaceutical purchasing power is chasing a pipeline problem that cannot be solved internally. I have spent 40 years watching these cycles. The windows that look most like danger are often the ones that create the most enduring wealth. The 3 windows are open. They will not remain open indefinitely. The sequence is in motion. Whether you act on it and how, that is your decision to make.